Hi, George. Thank you so much for joining us today. You are fast acquiring a reputation in the market of a person who takes big, bold calls and backs it up with a lot of conviction in your portfolios and in your communication with distributors. I remember about 18 months ago, you were on front foot, talking about small caps at a time when small caps were completely beaten down, and you gave a very strong and cogent logic about why you were very optimistic on that. That obviously played out brilliantly. Small caps have significantly outperformed mid and large caps in this rally. I remember about 10, 12 months ago when there was a lot of gloom. You were among the first people on our platform who made a very strong call around old economy stocks, and you drew the analogy of a 2003 to 2008. You predicted that we are most likely to see a repeat of that, which is basically old economy taking the lead and new economy taking a backseat. Well, in the last 10, 12 months, that clearly has happened. Some people like to believe it's just a mean reversion and, things will then sort of settle down. Other people believe, otherwise. But fact is that old economy has delivered big time in the last 10, 12 months. And now I am really curious to see the new statement that you have put out, where you're saying that unique positioning equal to unique results, and how you have now completely repositioned all your equity schemes in light with change in your thinking in terms of what will actually deliver alpha in the coming 12 to 24 months. So, we are really hoping that this will be a hat trick for you in terms of successful calls. But what is this unique positioning? What's the change in thinking? What has led to the change in thinking, and what has that resulted in terms of sectoral preferences?
Thank you, Vijay. Nice talking to you always. It has been pleasure. Last 1.5 years time, a lot of calls what we took worked out well for us.
Yes.
A lot of it is, in hindsight, it will look like a luck, but some luck and skill always plays
Go hand in
in
hand.
our
Yes.
manager role. So I would say that what we were thinking 1.5 years back was market was extremely cheap, and there is a lot of room for surprise to come because people were very pessimistic. And actually, to all of our surprise, when the corona was actually building up in India, and the number of cases moving up, actually market went up.
Correct.
For all the crash happened before corona, all right, and we saw that the liquidity will be a big game in town, and which is what actually worked
Has worked out. Yeah.
well. Secondly, if you see from December 2019 quarterly results onwards, it was very clear that the corporate profitability is moving up, and the corporate profits as a whole is on the turning ground, and that has happened since then. But March was a big surprise because of Corona, and a lot of impact because of that came in for various corporates. But nevertheless, I think that that turning point was very clear at that point in time, and September 2020 onwards, the corporate profits start moving up, and that trend is a mega trend in my view, and it will continue to happen. So as we move forward, we will see that earnings growth surprising on the upside,
On the upside.
and people who are looking at the earnings to come down, and maybe a third wave to come in and things like that, probably they might get a significant positive surprise on the earnings growth front. As we speak, when we analyze the earnings growth rate, it is one of the highest in the last 20 years.
Mm.
But to my mind, that is going to be a big change, turning point in the entire market growth acceleration point of view. Because last 11 years, we have not seen earnings growth acceleration. And that is turning, and that is something which we double guessed in when we came up with our small cap NFO, and that is what eventually happened. So when the earnings growth picks up, and when the market is very cheap, that is a very interesting scenario for small caps to perform,
Correct.
and which we have seen happening by now. And we are of the opinion that the small caps even today from current point of time also can do well, but at the same time the stocks what you have to have in the portfolio has to be very different, because a lot of stocks which were looking extremely attractive has become very expensive in matter of 1.5 years time. and it is pricing in more than 3 years forward earnings also. So it is bound to get into an accident zone. So it's better to move into the stocks where it is not priced in. So we have looked at all the activities in the market. We have talked to various managements, companies. How the entire macro is shaping up, and how the micro also is looking like. So what we clearly understand is that the domestic economy is going to do very well, and that is what you have to bet on from the current point in time.
Okay.
So we will be significantly low on global cyclicals,
Okay.
be it metals, or chemicals. We think that, it is extremely overvalued in those
Okay.
segments, and even global IT as well. So IT stocks are
Okay.
pricing moon at this point in time. If you see small cap IT, mid cap IT is trading at a significant premium to large caps, which is a big risk in our opinion. So we would like to take profits out of these sectors and move into domestic oriented sectors which have not performed well and which are part of the early cyclical theme.
Okay.
If you see banking stocks, mid and small cap banks have not performed well, and it's trading ridiculously cheap. And also, if you look at some of the consumer goods names, which are very strong balance sheets, good brand image in the market, and have good promoters running those businesses. So those businesses are looking extremely attractive to us, which is where we have concentrated the portfolio because the balance sheets are good. So we don't mind concentrating on those names. So consumer goods looks very attractive. Within the defensive names, between sectors like pharma or FMCG, our preference is towards pharma because that looks extremely attractive. And after 5 years of bad performance in these companies, the things are looking up. So our portfolios are significantly or very very differently positioned related to the peers, mainly because of the fact that we see opportunities in these segments or these sectors, and we have moved out of the global cyclical sectors, excluding oil and gas. So oil and gas, especially the refining cycle, is looking extremely strong, and we believe that as we move forward in next 2 years, maybe refining cycle can get into a super cycle. So that's where we believe that refining stocks looks very very interesting at this point in time.
Okay.
So that's why we are not leaving
Sorry.
oil and gas. So
Okay.
net domestic cyclicals, which we were talking about, as a big big winner in the next 2 to 3 years time, and that is what we would like to bet on at this juncture.
And domestic cyclicals will also include real estate?
Yeah, for real estate, for first early cyclicals is where we are betting on at this point in time. And then we would like to move into the deep cyclicals like real estate as well as capital goods, engineering, utilities, infrastructure related companies. That because a lot of companies have had a very significant run in the last 1.5 years. So you would look for an opportunity there, because today if you see auto ancillary has not performed in the last 4 years, and consumer goods have not performed. 2 years was corona, because of which there was no footfall and there was no activity around it. So all those have given a lot of room, margin of safety, as we always say that margin of safety, quality of the business, low leverage. SQL is our investment philosophy. It perfectly fits into that philosophy. We are seeing good margin of safety companies, good quality companies, good branded companies available, low leverage entities at a very attractive valuation. So that's where we have concentrated our portfolios.
So discretionary consumption is your big theme right now, if I understand correct.
Early cyclicals, I call them
early
as
cyclicals,
because banks and early cyclicals are the ones which will auto ancillaries are part of early cyclicals, which has generally done well when the economy starts improving. So I'm still sticking to the cyclicals, the old economy cyclical theme to work well in India, and that is the bet which we are taking for the next decade, and that holds good even today. But the pocket of opportunity at this juncture after the big run up has to, we have tamed down our expectations, some of the sectors, and move to more quality and where we see a lot of upside left.
Got it. Got it. So, George, I'm just curious to get a perspective on one issue that I picked up in, hearing you. You said that metals are looking very frothy, and you said that oil and gas looks like perhaps set for a super cycle, the refining companies. Now, interestingly, if you look at metals, they are all trading at in on the basis of current earnings, they're trading at 5 PE. Whether you take the entire steel sector, whether you take a conglomerate like Vedanta, any of the metal companies, 5, 6 PE is where they are, which optically looks very cheap. Now, your BPCL, HPCL, all of the refining companies are also trading around that 5, 6 PE kind of a thing. So I'm just trying to understand why one 5 PE is frothy and the other 5 PE is juicy.
Yeah, well, actually, Vijay, this I learned very late, actually, when there are sectors where you have to bet when the companies are declaring losses.
Hmm,
And that is typically the metal sector. When the companies are declaring losses and you're the largest company in that sector declaring losses, that's the best time to get into metals. Because
hmm,
ultimately what happens in metal sector is that the sentiment changes very fast, right? And we have seen that in the last 1.5 years. From point 4 times book, some of the largest steel company trading today, it is trading at 2.5 times price to book. For generally, price to earnings is not a good indicator, because at the bottom, when the sector is the largest ones are declaring losses, most likely the price to earnings multiple is not defined, because earnings itself is zero or negative. Then you will have a negative PE
hmm.
most likely. Or when things are looking very good, what happens is that the profitability might be visible at the peak most of the time, and that time probably the price to earnings also will look very different. So maybe that's a time to sell as well. For when
Okay.
sometimes we used to say in our fund management parlance that when the PE is high, you sell, or P is high, you buy, because
Or
that's the
metals
time
at
the
least.
earnings are
Yeah.
depressed,
Hmm,
right? And when P is low, you sell the sector,
hmm,
right? So, but that is not the case fully in the case of metals. Actually, the improvement in balance sheets are happening, but at the same time, I feel that when you look at the margins, right? The spreads, for that is at the highest ever in history, right? For when the spreads are so high, there is a chances of significant disappointment coming through, because these spreads are not sustainable.
hmm.
Some of the steel players starts opening up when seeing these spreads. Some of the locked capacity starts opening up. You will see these spreads coming off, because
Right.
it's a pure economic theory, right? When you
Sure.
see the spreads are so high, a lot of spare capacity people are having, they start opening up, because earlier it was not viable. Now it is looking very profitable. So that will keep happening. So that I believe that in the case of oil and gas, the other way around, the margins are at the lowest point, right? Especially in the refining side, it's at the lowest point it is trading.
Hmm,
So both sectors are at a diametrically opposite. On one
hmm.
side, the margins are the highest, and one side, the margins are lowest. And on the lowest margins also, the price to book multiple of these stocks are trading at a ridiculously cheap. And inherently speaking, refining stocks generally have return on equity upwards of 15%, and it goes up to 22, 23% also. So it is far more better businesses compared to metal stocks, come what may, because metal stocks generally don't have reasonable ROEs on a 10-year basis or 15-year basis also, right?
Hmm.
It is normally below 8p, 9p, and 8% ROE,
Percent,
or
9%.
so it is below the cost of equity. Most of the ROEs are.
Hmm.
In that way, I think refining business are much more better businesses to own. Only thing is that here again it is a commodity. The refining cycle has to play out the way we are thinking. If it pans out, I think there is a lot of money to be made,
And
because
why do you think that there could be a super cycle? I mean, what's changing at the margin in the refining space?
yeah, for there are two three things. One is on the some of the regulatory norms are changing,
Hmm,
and secondly, there are shortages in different parts of the world, which is occurring because of the inconsistencies of this COVID and related opening up. So I think that is more towards a lot of challenges on that regard. Thirdly, there is a lack of capex being done in the last 5-6 years, because
Right.
people thought that oil is going to be
Oil is dirty nowadays. It's a dirty word.
oil is going to be dead, and people thought that no capex required to be done. So I think very few companies who have done capex will thrive on their increased capacities, and some of the Indian companies are by default run by government also has been beneficiaries of that. But to my mind, they some of the PSU names in that regard is looking extremely attractive to us, and it can be a multi-bagger also from these levels. So in that way, it is a good sector to be in at the right time of the cycle.
Okay. Okay. So, George, I want to go back to the earlier two calls that you had made, and from a distributor's point of view, if he has actually gone ahead and communicated your call. So, let's say you had a big call on small caps, and let's say distributors have gone and advocated small cap funds to their investors. Is this a time to book some profits because you see a little bit of froth in the small cap space, or do you say that just stay in for the next 5 years, don't worry about interim volatility?
Yeah, for Vijay, I would answer this very, very differently, because there is no straight yes or no for it, because it depends upon your risk appetite and where you stand in terms of your investing experience, right? Because if you had started in March 2020, your experience will be very different. Whereas if you have started much, in the year 2018, then your experience would be very different. In our case, anyway, our funds came only in February 2020. The most of them are sitting on decent profits. But I would say that you know one thing I've learned over a period of time is that you have to look at the earnings cycle, right? Whether the earnings have peaked out, and on the peaked out earnings, the price to earnings multiple we are paying for buying these stocks, then obviously the risk that you're carrying is very high. Today, I would say that the earnings have just started to improve. Only 3 quarters it improved. Then by the time the fourth quarter improvement happening, you saw that the second wave of COVID hit us, right? And there was a slowdown. So I am clearly believing that the earnings cycle is going to improve substantially from here, and there are signs of it. If you see the PMIs have moved to 55 and above, you see the growth rates monthly, high frequency indicators are suggesting the growth picking up smartly. The e-way bill and various data is clearly showing that the business is coming back, even GST collection and everything. So I believe that we are in for a significant earnings surprise on the upside, which is what I mentioned in the beginning itself. For earnings growth as well as absolute earnings of corporates are going to be a significant surprise in the coming years. And that is where you need to wait and watch. It's not the time to dump the stocks or funds. You wait it out for the earnings peak to happen. I think that will happen maybe 4 or 5 years from now, right? For till that time, there is a good room for earnings expansion. People will keep guessing that the markets have peaked out, and but it will not peak out till the time you see the earnings peaking out. When the earnings peaks out, and on top of it, the valuation becomes extremely frothy, like what we saw in the year 2007. That is when you have to get rid of some of the small caps and mid caps, and then move to some of the safer names, safer funds. But today is not the time to do that, because you have just started the ride. You write the entire earnings growth story, and then you move out of these sectors. But nevertheless, I would say that some of them who have invested at 6 rupees NAV in our funds and sitting at 16 rupees at this point in time, obviously they have definitely an opportunity to book profits if they feel like, and we don't say no or yes to it, because it depends upon their risk appetite. But I would say that there is more room for surprise on the upside, and we have readjusted the portfolio, the requirement.
So I guess a better way in terms of guidance for a distributor from hearing you is when we are looking at mid and small cap funds of our customers, look at the portfolio composition. If the portfolio continues to be heavily skewed towards global cyclicals, which is like you mentioned, IT and chemicals and metals, etc., then become cautious about those kind of portfolios.
Definitely,
But
definitely.
portfolios that have proactively moved from global cyclicals to domestic cyclicals, there's no reason to get worried about frothiness of the portfolio. Would that be a fair statement?
Absolutely, absolutely. You are bang on it, Vijay. When I look at some of the industry peers, the some of the AUMs are significantly higher, and
Yes,
to readjust the portfolio also becomes very difficult.
becomes a
So
challenge.
that's where we have decided at our end that at ITI Mutual Fund, the small cap portfolio, we don't want to cross 2,000 crores by any means,
Hmm.
right? At the time of NFO itself, we kept on saying the same thing, and we don't want to, because once it crosses more than 2,000 crores at the current liquidity levels, it is impossible for me to reposition the portfolio when it is required to,
Hmm.
right? If it is a balance advantage fund or large cap or multi cap long term equity, I don't have an issue because I can take as much as money in that funds, because the repositioning is not a difficult thing there. Here it becomes almost, if I take the position to an astronomical level, it becomes very difficult for me to, I can only watch the stock falling,
Hmm.
there won't be any exit available, right? For we are mindful of that fact, because ultimately we are dealing with public money. So we have at our size, it is quite easy for us to readjust ourselves, because it's just about near about 400 crores and above AUM, so that it is not very difficult for us to readjust. And we have done that. And at a portfolio positioning level, I am very comfortable across funds. I can tell you that it is a very unique position.
Hmm.
Somebody who is diligent and seasoned distributor can easily make out that this is a not a portfolio, it's a me too portfolio which has been constructed looking at the benchmark or looking at the market flavor. It's a very different, it's clearly away from the crowd portfolio. And I believe that, that positioning is going to pay off significantly in the
Got it.
next 1 or 2 years time.
Sure. One final question, George. Good you mentioned about the seasoned distributors and advisors. So some of these seasoned distributors, advisors who I speak with, they've been following, two or three signals to understand from their own point of view whether market is looking a little frothy or no, and therefore, whether to take some money off the table for their clients. One is, of course, the equity portion of BAFs, which today is hitting all-time lows because valuations are at least optically looking quite expensive. So that is one sort of red signal that some of them are pointing out. The other red signal is that there is clearly a lot of enthusiasm in the IPO space. And now that enthusiasm has spilled on, phenomenally into the NFO space. I never thought we'll see a five-digit, NFO collection. We've seen two of them. So some of the more sort of seasoned veterans are saying that look, when a BAF is giving you a warning signal in terms of overall market valuations, and when money is flowing to levels that we never thought, which we are seeing in IPOs and now in NFOs, then maybe it is time to get a little cautious. So how would you react to this concern?
Yeah, but the so-called, the seasoned distributors also would have participated in these NFOs.
Yes.
Otherwise, this much money would have come in, right?
Otherwise, they could not have collected five-digit number.
Collect so much money, right? For 10,000 crores and above, funds collecting, it is a dream. I'm very happy that some of our peers are able to collect in that fashion, which is a very good thing. But, as I have a different take at this juncture, even relating to the BAF equity level, as well as, looking at the frothiness. See, what we have seen, that's why I was mentioning some time back in the previous interviews also, we are more or less in the 2000 to 2010 kind of phase. In this phase, I'm not saying that, correction will not happen. Correction will happen, and bull market correction can be brutal, and, it can be suddenly people start feeling that, everything is going down,
Hmm.
and it will reverse also very fast. So that's what we have seen, 1 month correction, and suddenly it will reverse. But we have seen 2000 to 2010 period, the earnings growth was the bigger game in town. right? For most of the BAF, which is constructed in the country, I was instrumental of setting up BAF in my previous organization also. I would say that it was more related to the valuation game,
Mm.
because 2000 to 2010 was a different era, and 2010 to 20 was a different era, right? Most of the BAFs came in the 2010 to 20 era, and prior to that, the earnings growth was a major game in town, 2000 to 2010. Now, 2010 to 20s, would have set up BAF, would have thought about only valuation, and that is what I also thought about in my when we were setting up BAF in my previous role. But while I joined ITI Mutual Fund, we have thought very differently. We said that let's look at what is going to be the next big theme to play, or biggest change which is going to happen to the market dynamics. It is going to be the earnings growth. Last 11 years there was no earnings growth acceleration, and if earnings growth acceleration happens, how it is going to pan out,
Mm.
right? So on that basis, we have tweaked the BAF model, and we have earnings growth as one of the main factors in the BAF model, along with the valuation, which is the price to book valuation, and also we are looking at some of the currency and some of the volatility angle also. So we call
Okay.
it as a VTV model for valuation, earnings growth trend, and volatility. So on that basis, when you evaluate the BAF equity level, because the earnings growth is, as I mentioned, it is one of the highest in the last 20 years, right? So people will get it wrong, is what I believe. In terms of when you look at only valuation, you will keep moving towards the low end of the equity level spectrum. But if you are looking at the earnings growth also combined, you will be at a much higher earnings growth. Ultimately that as earnings growth picks up, the market is going to behave very differently, and that's what we have seen between 2000 to 2010. In between, corrections will come, but ultimately the money making opportunity will be there. Yeah, and earnings growth will be the biggest game in town,
Mm.
and that is something which we can't forget.
Got it.
So I am not of the opinion that we are completely into fraud, because we are still corporate profits to GDP at 2.2%, which is one of the lowest, like in the year 2000, 2001. And we are, and also we are seeing that earnings growth smartly picking up across sectors,
Mm.
right? And especially so in the domestic oriented sectors. So if you're, our thinking in BAF is our earnings growth is going to be the biggest differentiator related to the peers. And every product we have thought in that manner, either by positioning or by the methodology at which we are running the product, has to be very, very different, so that there is something which a distributor can look at our product differently,
Mm.
and come into that product. So the experience in that product can be very different compared to the peers. So I am not of the opinion that we are at the peak of the markets. Obviously, the IPOs are swinging very hard, and also the NFOs have been collecting significant amount of money, which is a little bit a worrisome factor, as you were rightly mentioning, because in 2007, 2017, we have seen IPOs ringing the bell. But I think this is there is an opportunity here, for the market peaking out, and the earnings growth peaking out. There is a
Mm.
room for at least maybe 4 or 5 years. You will have a good catch available even in the to make money.
Got it. Got it. Excellent. Thank you so much, George. Very, very succinct and very logical thought process as usual. We've seen two of your big calls going, spectacularly right. I all the very best for you to score a hat trick with this call. Your the positioning of your funds is definitely unique. The refining of the thought from old economy to saying early domestic cyclicals is, I think, makes a lot of sense. And I think the rationale that you've given about why one has to be a little circumspect on the global cyclicals does make a lot of sense. It's great that you've already repositioned your funds, along the lines of your current thinking. All the very best to you and your team to collect all the money that you think you should collect with this positioning, obviously on the back of performance and the fact that you've been getting your calls right. I'm sure you'll find a lot more support in the coming quarters for the way you positioned your portfolios. Thank you for joining us today, and all the very best to you and your team.
Thank you, Vijay. It's always pleasure. So I would definitely say that the unique positioning is definitely going to result in a unique performance as well. So
Right.
it is going to be a very interesting time for us as fund managers, and we have repositioned our portfolios. We have concentrated our portfolios significantly. None of our portfolios have more than 20 to 40 stocks, and we believe that the consolidation has happened at the right time, and the results will follow. So please stay tuned with our portfolios, and Vijay, please look at our funds as well.
Sure. Thank you so much, George. Thanks
Sure.
a
Thank
lot
you.
for joining us.